Hey everyone, welcome back to Corporate Decoder. Today we're diving into the annual report of Kinsale Capital Group, and let me tell you, this one's a roller coaster. It's got profits soaring, but also a bunch of potential disasters lurking around the corner, so buckle up. Kinsale Capital Group, based out of Richmond, Virginia, focuses on a specific type of insurance, excess and surplus lines. Basically, they cover unusual or hard-to-place risks that regular insurance companies might avoid. Think newly established businesses, high-risk operations, or companies with a history of losses. And guess what? They're doing really well, the numbers don't lie. For the year that ended December 31st, 2024, their gross written premiums, which is basically the money they're making from selling policies, jumped almost 20% to $1.9 billion. But it's not just about making money, it's about how well you're doing with that money. Their return on equity, a measure of profitability, was a very high 32.3%. To add to the great results, Kinsale stock, under the ticker symbol KNSL, has delivered a compounded 49.7% annual gain. So where's all this money coming from? Well, it's a mix. Commercial property makes up the biggest chunk at 24.4%, followed by excess casualty, which is 13.1%, and small business casualty at 10.5%. One of Kinsale's big strengths is its exclusive focus on the excess and surplus lines market. This market has historically been more profitable than the regular insurance market because they have the flexibility to charge higher rates. They also have underwriting expertise, which is a fancy word for carefully selecting and pricing the risks they take on. Technology is a core competency. They also run a tight ship when it comes to expenses. Their expense ratio was 20.6%, which they claim is significantly lower than their competitors. Also, their claims department has been found to be very efficient. So how are they planning to keep this going? Their strategy is pretty straightforward. They want to expand their market share, generate underwriting profits, and use technology to stay efficient. They also aim to keep a strong balance sheet. They sell their policies through a network of independent brokers, but they rely on a few big ones. Their top 3 brokers bring in almost half of their business. Geographically, they do a lot of business in California, Florida, and Texas. So anything that hits those states hard, like a hurricane or an earthquake, could really hurt Kinsale. Speaking of disasters, they do use these fancy computer models to estimate their probable maximum loss, or PML, from catastrophes like hurricanes. To limit their exposure to big losses, they buy reinsurance. Think of it as insurance for insurance companies. If Kinsale gets hit with a massive claim, the reinsurer helps them pay it. Alright, let's talk about where Kinsale keeps all its money. The vast majority is in fixed maturity securities, kind of like bonds, and most of those are rated AA or higher. This means they're generally pretty safe investments. However, they are subject to risks, including credit and interest rate risks. But it's not all sunshine and roses. The insurance market is super competitive. They're up against giants like Berkshire Hathaway and American International Group, who have way more resources. And of course, being an insurance company means dealing with tons of regulations. State insurance laws dictate everything from capital requirements to what they can invest in. Plus, there's the ever-present threat of federal regulations shaking things up. Now for the fun part, the risks. Kinsale themselves lists a whole bunch of things that could go wrong in their report. First up, their loss reserves might not be enough to cover actual losses. Loss reserves are the estimated amount of money the company sets aside to pay out future claims, so it's a risk that's a bit of a gamble in itself. Also, it's also worth remembering that they rely on models to predict future losses, and models are never perfect. Actual losses could be way higher than expected. If they can't get reinsurance at a good price, or if their reinsurance doesn't cover enough, they're in trouble. Severe weather and other catastrophes could really hurt their business, and it's also worth remembering that climate change might make these events more frequent and intense. Economic downturns, inflation, or high unemployment could lead to fewer people buying insurance or more people filing claims. This, in turn, could affect their growth and profitability. They also point out that losing key executives or failing to attract and retain qualified personnel could be a major problem. They depend on having a skilled team to underwrite these complex risks. Another risk, their employees might take excessive risks. They incentivize employees to take risk by giving stock compensation. That could lead to an increase in accidents. And of course, there's always the risk of getting sued. Legal battles can be costly and time-consuming. Also, there's cybersecurity. The company engages multiple vendors with subject matter and technological expertise in various aspects of cybersecurity management. The CEO is responsible for assessing and managing overall material risks to the company. With respect to cybersecurity risks, our CEO leverages the collective expertise of the company's information security function, which reports to our CEO through the company's chief information officer. And for all you shareholders, it's important to know that state insurance laws limit how much Kinsale Insurance can pay out in dividends to its parent company, which in turn affects how much it can pay to you. One final point, the credit agreements contain a number of financial and other covenants which could make borrowing more expensive if broken. In some miscellaneous news, one director, Gregory M. Scher, adopted a Rule 10b 5-to-1 trading plan on December 11, 2024, that extends until 2026. Now let's zoom out and take a look at the big picture. Kinsale Capital Group has delivered strong results, capitalizing on opportunities in the excess and surplus lines insurance market. Their focus on specialty risks, efficient operations, and use of technology seems to be paying off. However, as the company points out itself, there are some definite weaknesses. Reliance on a few key brokers, geographic concentration in disaster-prone states, and the potential for employees to take on too much risk. On the opportunity side, they have more flexibility and expertise than other companies with the possibility of the sector's growth as well. All in all, Kinsale Capital Group has some issues to solve, but it's certainly an interesting company to keep an eye on. Thanks for watching. If you found this breakdown helpful, be sure to subscribe to Corporate Decoder for more clear and concise financial analysis. What company do you want us to look at next? Let me know in the comments below.